Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of market manipulation, understanding tactics, impacts, and how to stay protected. Use of technical analysis. Technical analysis is one of the most effective tools for identifying unusual behavior in the markets. It helps traders interpret price and volume data to spot inconsistencies that might signal manipulation. Here's how it can assist. Volume analysis. Technical tools can reveal unusual spikes in trading volume. If high volume occurs without price alignment or fundamental justifications, it could be manipulation. Look for volume that doesn't match past trends. Chart patterns. Patterns like sudden, sharp price movements or repeated false breakouts can indicate tampering. Chart analysis can highlight disruptions in normal trading behavior that wouldn't otherwise be obvious. Relative Strength Index, RSI. RSI helps measure whether an asset is overbought or oversold. When the RSI reaches extreme levels, it might suggest manipulation, especially when aligned with other signs like volume spikes. Order flow tracking. Some platforms let traders analyze order flow, revealing large orders designed to influence the market. For example, excessive bid or ask sizes placed without execution could be signs of spoofing. Support and resistance levels. If prices repeatedly break through established support or resistance levels without logical catalysts, it may not be genuine activity. Manipulators often target these zones to trigger automated trades. Using technical analysis as part of your strategy can help you filter noise from reality. Think of it like a magnifying glass for the market, allowing you to see the fine details others might miss. Recognizing manipulation requires a blend of observation, skepticism, and data interpretation. By understanding key indicators and applying technical tools, traders can act decisively and avoid traps set by manipulators. Impact of market manipulation. Market manipulation creates ripples far beyond individual investors. It shakes trust, challenges regulations, and distorts the fairness of financial markets. Understanding its effects and how oversight has evolved is essential to grasp the broader consequences. Effects on investor confidence. Market manipulation erodes the trust that drives financial markets. A market thrives on a delicate balance of integrity and transparency. When investors suspect manipulation, that trust starts to crumble. Think of an investor entering the market with optimism, only to realize they've been duped by inflated stock prices or misleading information. This experience creates hesitation. People begin to question whether they're playing on fair ground or in a rigged game. It's no surprise then that many retail investors, after falling for these schemes, withdraw from the markets entirely. Here's why this matters. Lower participation. Fewer participants result in less liquidity, limiting genuine price discovery. Increased skepticism. Small events can create massive panic, as investors act defensively when trust is low. Flight to safer assets. Instead of investing in stocks or innovative markets, investors park funds in low-risk options like government bonds or savings accounts. This erosion in confidence doesn't just affect individuals. It creates a ripple effect, harming businesses that rely on stock markets to raise capital. When fewer investors engage, the markets fail to deliver on their core purpose, facilitating efficient allocation of resources. Regulatory responses. Combating market manipulation has been a challenging, ongoing battle for regulators. Financial markets are complex, and manipulators consistently adapt to exploit loopholes. Regulations have evolved to keep up, but the task is far from simple. Key milestones in regulatory development include the Securities Act of 1933, one of the first federal laws aimed at ensuring transparency and preventing deceitful practices. Created after the 1929 crash, it laid the foundation for modern market regulations. The Securities Exchange Act of 1934. This established the SEC, Securities and Exchange Commission, to oversee and enforce trading rules, monitor potential abuses, and protect investors. Dodd-Frank Act, 2010. After the 2008 financial crisis, new rules targeted fraud in derivatives markets and strengthened whistleblower protections. Modern regulators also rely heavily on technology and data systems. Advanced algorithms now monitor for unusual trading activity, making it harder for manipulators to go undetected. However, as technology advances, so do the schemes. To stay ahead, global collaborations between agencies, like the SEC and Europe's ESMA, European Securities and Markets Authority, are more crucial than ever. Manipulation doesn't respect borders, so neither can oversight. But regulation is not foolproof. Critics argue that penalties for manipulators often pale in comparison to the profits made. For many, the risk is simply worth it. This highlights the need for stronger deterrence, including stricter punishments and better international cooperation. Ultimately, regulatory oversight acts like the referee in a fast-paced game. It can't always prevent bad behavior but is vital to maintaining order. Without such oversight, markets would likely spiral into chaos. Preventing market manipulation. Preventing market manipulation requires effort from both regulators and individual investors. While regulatory bodies create rules and monitor activity, investors can take steps to protect themselves. This balance helps ensure fair and transparent markets. Role of regulatory bodies. Organizations like the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, are the frontline defense against market manipulation in the United States. Their job is to enforce laws, investigate suspicious activity, and ensure a level playing field for all market participants. The SEC focuses on protecting investors and maintaining fair market practices. It monitors stock trading, mutual funds, and other securities. When manipulation is detected, the SEC takes legal action, which may include fines or criminal charges. The CFTC oversees derivatives markets, including futures and options. This agency is particularly active in cases involving commodities and cryptocurrencies. Regulators not only investigate fraud but also work to prevent it. They require firms to submit regular disclosures, conduct audits, and meet strict reporting standards. These actions add transparency, making manipulative practices harder to hide. Outside the U.S., international regulators like the Financial Conduct Authority, FCA, in the UK or European Securities and Markets Authority, ESMA, serve similar roles. With financial markets interconnected across borders, these agencies often collaborate on enforcement efforts to catch global schemes. However, regulators face challenges. New tactics and technologies, such as algorithmic trading, often outpace regulations. This is why ongoing updates to laws and enhanced data monitoring systems are key to staying ahead of bad actors. Best practices for investors. While regulators provide protection, investors play a critical role in shielding themselves from manipulation. Staying informed and adopting cautious habits can make a significant difference. Here are some actionable tips every investor should follow. Do your research. Never rely solely on social media or forum hype. Verify claims with trusted sources. Pay attention to fundamentals like earnings reports, industry trends, and company leadership. Watch for red flags. Unusual price or volume spikes, especially without clear news, can indicate manipulation. Be wary of stocks or assets being aggressively promoted without substance. Avoid FOMO, fear of missing out. Emotional decisions often lead to losses. Manipulators count on you jumping in blindly. Take time to evaluate whether an opportunity aligns with your long-term investment goals. Diversify your portfolio. Spreading investments reduces the risk of being wiped out by a single manipulated stock. Include a mix of asset types, industries, and geographies to stay balanced. Review the order book. Analyze buy and sell orders if your trading platform allows. Cancelled orders or large, sudden surges could suggest spoofing. Be careful with margin trading. Borrowing to invest increases risk. Avoid it unless you're highly experienced. Investors should also leverage available tools and resources. Use stop losses. These protect against steep losses by automatically selling a stock if its price drops below a certain level. Monitor news closely. Keep track of regulator announcements and market-wide developments. Subscribe to alerts. Many trading apps offer alerts for unusual market activity, helping you stay informed. As manipulation schemes evolve, staying vigilant is critical. Think of investing like driving. defensive strategies are your safety belt. By being careful and aware, you can navigate around potential pitfalls and minimize risks. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.